I need you to forget everything that you have heard in the mainstream media lately regarding a soft landing or no landing.
Soft landing feels like a pretty likely scenario.
They figure the only outcome is a soft landing for the economy, which means it's foolish to sell now, since you'll only end up buying back those same stocks at higher leverage.
The new data isn't predicting a soft landing. In fact, it's not even predicting a hard landing. It is predicting a crash landing. And I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go over the inversion in the yield curve. And I know a lot of you are saying, I get it, George, the curve is inverted. But what you don't understand is what's happening right now as we speak underneath the surface. So let's look at a chart going all the way back to October 24th. So a very recent chart to today's date. We go from 4.4% on the left up to 5%. Now this is a chart of the 10-year Treasury yield. But let's not forget the recent narrative. I'm sure you guys have been hearing it in the mainstream media and on financial Twitter. We have massive supply of treasuries coming online. Janet Yellen is auctioning off all this government debt. We have a massive oversupply. The deficits are exploding higher, which means the government is going to have to issue more and more of these treasuries, which is going to inundate the market with supply, and therefore prices will go down. In other words, yields will go straight up, and it'll be this debt doom loop that you hear about. Because the yields go up, the interest that we have to pay on the debt goes up even more. Then we have to issue more bonds, which makes the interest rate go even higher. But let's look at what the data is actually saying. So the 10-year Treasury yield back on October 24th, right around 5%, it's gone straight down to where it is today. In fact, just the other day, I saw it was under 4.4%, trading right around 4.36%. So wait a minute, how is this possible? Because let's remember that there's an inverse relationship between the yield and the price. So if the yield is going down, the price is going up. But how on earth is the price going up when the supply of treasuries and the supply expectations are increasing at a rate that would make your head spin? Well, there's only one answer, because demand is going up at a faster rate than supply and supply expectations. So right about now, your friend and family member Fred is watching this video. He says, oh, that George guy, he doesn't know what he's talking about. He's just an economic version of Alex Jones, him and his tinfoil hat, all this fear-mongering. It's obvious to anyone paying attention that the reason there may be more demand for the long end of the curve or 10-year treasuries is because the Fed is going to drop interest rates because they've tamed inflation, because they've done such an amazing job. And they're going to be able to lower interest rates, and we're going to have an economic boom. It's not a crash landing. That proves the no landing hypothesis. But what your friend and family member Fred doesn't realize, long-term interest rates are based on growth and inflation expectations. So if we see the yields going down on the 10-year, which is inverting the yield curve to a greater degree, this means the market is predicting a hard landing or a crash landing. And it is true that the market's predicting that the Fed is going to drop rates, but not because we have a booming economy. It's because the stuff is hitting the fan. So you see, the market, or your friend and family member Fred's problem, is they think the Federal Reserve controls interest rates, but they've got it backwards. The Federal Reserve responds to market conditions, and the interest rates predict what those market conditions are going to be.
Step number 2. Now let's take a look at what central banks are doing around the world right now and what this means for what they'll likely do in the future moving into 2024. And this would include the Federal Reserve. We go straight to MarketWatch. Title of this article, Central Banks Are Cutting Interest Rates at Fastest Clip in Years. When will the Fed join them? And I'd like to highlight this first talking point they have. Analysts caution that the interest rate cuts do not guarantee a soft landing. So investors should be careful what they wish for. I agree completely. Then the article points out a fantastic chart going all the way back to January of 2021, and it shows the relationship between the global central banks that are cutting interest rates and raising interest rates. And what we can see starting just last month is that now more central banks are cutting interest rates globally than increasing interest rates. They go on to quote an economist they interviewed for the story. The interesting thing at the moment is that cuts are priced in on a soft landing scenario. So I think they may be right for the wrong reasons, meaning that they're right that we'll see interest rate cuts, but not because we're getting a soft landing, because we're getting a hard landing. He goes on to say, and eventually you'll see more cuts than are priced in due to a harder landing than is priced. Interesting times ahead, meaning that the market is most likely offsides. The market is misinterpreting the lower interest rates that we see on the 10-year Treasury that we discussed in step number 1. And by the way, it makes a lot of sense that global banks on net balance are cutting interest rates right now, because when we get into step number 3, I'm going to show you how a lot of the data is suggesting that we're actually in a recession right now as we speak. Let's get back to the article. The Fed started raising interest rates in March 22 to combat the worst wave of inflation since the early 1980s. Now, I want to go through a quick thought experiment with you. In March of 2022, did the Fed raise rates or did they actually lower them? Here's what I'm talking about. Let's assume for a moment that the Fed did nothing. They didn't increase the Fed funds rate. They just sat back and said, you know what, we're taking a vacation. We're going to go play golf. And let's also assume that the CPI went from 1.5 to 3 to 4, all the way up to 9%, exactly what we saw. What do you think would have happened to the 10-year Treasury yield? Do you think it would have stayed the same? Or do you think it would have gone up? Of course it would have gone up. And I would argue that it probably would have gone up higher than it did with the Fed increasing interest rates. Let's remember that right around the time the CPI was at 9%, the 10-year Treasury was only trading around 4%, 5% less than current headline CPI. So if the Fed funds rate would have still been at 0%, I think there's a very strong argument that the 10-year Treasury yield would have been a lot higher than 4%. But you see, this is what the market doesn't understand. They believe that the Fed controls interest rates. Therefore, if we see this inversion in the curve, then that might mean nothing more than the Fed is going to lower rates. When in reality, it's telling, in fact, it's screaming at you that inflation and growth expectations are going to decline in the future as a result of a hard landing at the very least. You want more proof? Let's go straight over to the Fed's website and check out a chart of the 3-month and 10-year Treasury yield. So we can see that we had an inversion just prior to the 1990s or late 1980s, we'll call it, prior to .com, prior to GFC, prior to the cerveza sickness, and then where we are today. But you have to ask yourself, was this inversion of the curve, in other words, the 10-year Treasury yield, just predicting that the Fed was going to drop rates, or was it predicting future growth and inflation expectations were going to decline? In other words, we're going to have a hard landing. Let's go right over to a chart of Fed funds, and we see that just prior to the 1990s, they started dropping rates, and oh, look at that. We had a recession. And let's fast forward to just prior to the .com bust. They started dropping rates there. The market was right, but oh, we had another hard landing. GFC, yeah, I'd call that a hard landing. So when you actually look through the data, it becomes crystal clear. The bond market, or these interest rates, don't predict what the Fed is going to do in isolation. They more so predict what the economy is going to do. And right now, these curves are screaming at us that the U.S. economy is going to slow down significantly. In fact, it's not just going to slow down, it's going to go in reverse.
Step number 3. Now let's go over those leading indicators that I was talking about in step number 2. More specifically, let's go over this chart, which is the Conference Board U.S. Leading Indicator Index. That's right. That's a mouthful. In fact, I had to look at it on my computer quite a few times. The editors are earning their money on that one. But basically, what this is 10 different categories. All right. What are they? Average work week, jobless claims, consumer goods orders, ISM new orders, orders on capital goods minus defense, building permits, stock prices, a leading credit index, interest rate spreads, and overall average consumer expectations. So this chart goes all the way back to 1980 to today's date on the left. We start mid-range here, go from 0 to 15%, and then from 0 down to negative 15%. And what you can see is every single time this index, as represented by these metrics or these inputs, goes negative, it's not just predicting a recession, but the United States is actually in a recession. Now, let me be very clear. There are a couple of exceptions. So we can see right here, let's call it 1995, right there. It's a little blip and a little blip. But right now we're at negative 7.6%. So to be as clear and concise and specific as I possibly can, we have never been more than negative 5% on this index and not actually been in a recession. And once again, right now, as we speak, we're at negative 7.6%. So are we going to have no landing, a soft landing, or a crash landing? Well, in these videos, I don't really make predictions. What I try to do is highlight the risks that you don't hear anywhere else, especially in the mainstream media. There are no certainties, there are only probabilities. But right now, the data is suggesting that moving into 2024, we'll likely see a recession, if not something worse. And, oh, by the way, we might be in a recession right now. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here. I will see you on the next video.